Hello, everyone. Welcome to another episode of Market Matters with me, Dr. Diffins. In this episode, we're going to discuss strategies for handling your emotions during a market downturn. At the recording of this video, the NASDAQ 100 is down approximately 25% from its 52-week high. And although it's rebounding a little bit here, there has definitely been a lot of pain that's been felt in the market over the last few months. I'm going to go ahead and zoom out here on this chart, and we see leading up to the pandemic, the market was, ebbing and flowing there. And then around March of 2020, it really took a dive, roughly 30% down here. And then from there, it's shot up and actually more than doubled from its lows here. And then now we're seeing a correction in the market. And of course, being down more than 20%, we're experiencing what's referred to as a bear market at this time. However, just to give you an idea of what this looks like in real terms, here is a snapshot of one of the portfolios that I'm running. Now, of course, these are different than the $1,000 ETF and index fund portfolio that I just started. But this is a real portfolio. It's one that I maintain through Interactive Brokers. And you can see here that this account is down close to $50,000. Now, I don't post this video on here to brag. Obviously, this money it's not a lot of money to begin with, but it is a lot of money to be down. So being down close to $50,000, I think back to my first teaching position, and I know my salary was under $40,000. So to be down more than what I was making in a year, that's problematic. However, there are some things that I have to keep in mind to help to keep me grounded during these periods of time. And I'd encourage you to do the same if you're currently invested or thinking about investing in the stock market. Know that there's going to be ebbs and flows in the stock market performance, as you can see here. But the key, remember we talked about this in another video, the key is just remembering to think about that top right part of the chart, that over time, the indexes at least continue to move upward, right? So when we have these little hiccups here, as long as we're invested and we continue to invest in the market, then over time, this too will eventually recover. Now, how long that takes obviously is going to depend on a multitude of factors, but it definitely will recover. Or I should say it eventually will recover, or should recover, if history is any indicator of the performance of the stock market. Same could be said from the S&P 500, or for the S&P 500, and finally the Dow Jones Industrial Average. Again, very similar. Saw precipitous decline here, followed by an increase. All right, so some of the strategies, and what I did was I pulled just two articles. You can Google strategies for dealing with market volatility, or bear market, market downturn, recession, and you will find a variety of articles that can help you to kind of process what you're seeing in the market. Now, depending on when you got into the stock market, if it was around these highs here, then obviously you'd be sitting likely at a significant loss in some of your positions. So I'm going to jump into this article. It's by Capital Group American Funds. Again, I just Googled it, found it, and strategies for dealing with market volatility. So this was interesting because it kind of gave me an opportunity to reflect on my current account. And these are just great strategies to keep in mind during this type of a market downturn, or at any time in the stock market if it's not going your way. Number one strategy that they have here is invest regularly in good and bad times. And this is important when you think about how the stock market operates. If you put all of your money in a purchase at one time, whether good or bad, then your money is kind of stagnant there. However, the key to investing is going to be to invest over the long term. This will be a good time for me to say a little disclaimer that I'm not a financial advisor and this is not financial advice. It's more just my thoughts on investing overall. Okay, so with that being said, you want to consider, if this is something that you're doing, you want to consider doing it over time. And again, that chart that we looked at earlier just shows the power in investing over time as the market increases. Okay, then the next tip would be avoid jumping in and out of the market. And this is something that I did constantly when I first started, would buy and sell companies probably every 2 or 3 days. And even though a lot of the brokers now have $0 commission, this is still problematic because what's going to end up happening, and there's been research to support this, is that the average investor makes, I think on average, somewhere around 5.5%. That's if they make a positive return at all, compared to an index that would be making between 10 and 14%. And a big part of that is just over trading or going in and out of the market. So because you can never time it perfectly, if you're in and out constantly, then you will very likely miss out on opportunities. The next one, maintaining a diversified portfolio. Diversification is extremely important. One way that you can do this, of course, would be to look to mixing up maybe stocks, bonds, things that you might hold as cash. You might look to gold and silver. You might also look at collectibles, different ways that you can diversify your portfolio. And of course, if you're thinking about just stock market investing, then of course you have that option of the ETF, right, that we looked at before, where, for example, with the NASDAQ or with the QQQs, you're having exposure to 500 companies, or the S&P 500, where you would have access to 500 companies. And then there's another index, or there's another ETF, I should say, that we haven't really explored, but if you Google it, you'll see it's called the total market, the total stock market. And I believe it's a Vanguard product, and it actually has about 4,000 stocks in it, and it spans the investment environment, if you will. All right, then the last one is don't forget history, and this is important, and we'll look at a calculator a little bit later, but just remembering that history piece that goes back to this chart, where although it's not a guarantee of the future, but you can look to history just to see the typical nature of the stock market, at least as it's been over the last couple of decades. Okay, so these were just 5 basic strategies. To build on those strategies, I'm going to go ahead and jump to a NerdWallet article, and this is 5 essential tips for investing in stocks, and very similar advice. The first one's checking your emotion at the door. This, I cannot stress enough, is extremely important. When you get into investing, first couple of trades that you make, you might be successful, you might not be successful, but if you're trading actively, then more than likely you're going to become invested in what it is that you're doing. A suggestion would be to refer to the simulator that was described in another video, and I'll link it in this video here. But to remember that your emotions, money obviously it's important to people. So if you become emotionally invested, then when your money is going down, it might cause you to panic, or it might cause you to throw in additional money to continue buying. And that is not sound investment practice. It's not a sound investment practice. Been there, done that, and have actually lost a lot of money, real money doing this. As opposed to this, you'll notice here it says unrealized profit loss here. So that means that even though this is down $50,000, the loss hasn't been realized. It will only be realized when and if these are sold. Because I'm staying in the market for the long term, I fully anticipate this number to, ebb and flow. It might increase, might decrease, but over time, eventually I expect it to turn positive, because I know that over time, or I believe over time, the stock market heads in that upper right side of the screen. So as far as it relates to emotions, if I'm constantly looking at my account, or I'm constantly thinking about the money that's at risk, it's going to be a problem, and it's going to, you're going to get into your head and start making mistakes. So if you're an investor, not a day trader or trader, if you're truly thinking long-term investing, then you need to remember that the markets are going to go up and down, but it will smooth out over time. You just have to keep the future in mind. The next one's going to be pick companies, not ticker symbols. And again, if you're new to stock market and you're stock picking, maybe you're watching different broadcasts, listening to different investors with different stock picks, or maybe friends or things that you read online. That's fine, but just remember that you want to research the core of the company that you're investing in. To say that every company is a good company to invest in would be absolutely wrong. Companies come and go all of the time, including big ones. So you'd want to make sure that you're invested in solid companies. And actually, this going back to this loss here, this account has a variety of stock tickers, individual tickers, and a few ETFs. And what this experience has taught me, just like when you make big money or you're down big money, you usually are kind of checked. Your investment planning or your investment strategy is checked. In this experience, when I recover from this, I'm going to go ahead and switch to a heavier weight of investing in ETFs, because what I'm realizing is that having that single stock risk is something that I really don't want to have. Yes, in good times, it may accelerate it may accelerate the account growth, but I think I'm okay taking on a more conservative percentage over time, as opposed to taking on single stock risk. Because again, if these single stocks start to collapse, then the money would, more or less be gone, as opposed to an ETF. If they were to absolutely collapse and have catastrophic results, it would only affect a few companies in that basket of companies in your ETF. All right, so then moving on to the third one, plan ahead for panicky times. And this is something that I've done, or again, I've learned over the years, and it's really just building up a kind of a shield in your mind to expect and anticipate that there's going to be times when the stock market goes against you. It goes against what you're anticipating. Nothing goes up forever. So it's a matter of just making sure that mentally you're prepared, that if the market does go down, that you're not using money that you need tomorrow, that you truly set a broad time horizon for when you're going to use your money, okay, or when you're going to need to access the money, okay? And then going to number 4, build up positions gradually. This is something that you will see actually in action on the ARC fund portfolio that was just created this week, as well as the index fund portfolio that was created. And this gradual buildup of position is actually one of the, it's very sound advice. The dollar cost averaging, that's where you're going to set regular intervals of purchases. So it might be once a week, once a month, once every other month. And you're just you're buying a set number of shares in either stocks or ETFs. So as the price goes down, you'd be able to pick up more shares. As the price goes up, you'll be able to pick up obviously fewer shares because they would be more expensive. But what's nice about dollar cost averaging is that over time, you're going to have a nice average. And so if you had $10,000 right now, instead of buying a $10,000 ETF or stock right now today, you might say, I'm going to break that up over the next 10 weeks. So that way, if the market fluctuates, I'd be able to purchase on an average basis as opposed to a one-time basis. And this is especially true if you're investing where you're going to put a little bit of money in, maybe each month, towards your positions. There's the buying in thirds, and this one, again, where you divide your money into threes, and then you just pick different points to buy, and then buying the basket. Again, this is either you buying a variety of stocks to offset single stock risk, or again, with the ETFs being as low cost as they are, an ETF would be an example of a basket that you could buy, and that would give you exposure and spread the risk across companies as opposed to having single stock risk. And then the last piece of advice here, the last tip, is to avoid trading overactivity. And this we kind of talked about in the last article that we looked at, the strategies. And this one is, again, if you're constantly looking at your portfolio, which is something that you will do as a new investor. If you go on there and you open a brokerage account, almost guarantee you that you are going to feel obsessed with your account. You're going to want to look at it. You're going to want to have the app on your phone. But however, please remember that you will be less successful if you do that. And this is proven statistics. The more that you can disassociate yourself from being actively involved. Remember, there's a video on ARK Invest, the ETF that's an actively managed ETF, or you might look to an index fund where it's a variety. That keeps you from having to do a lot of research because other people are doing it for you. That's going to keep you from having to be in and out of stocks because by nature of the index, it's going to happen. It will keep you from over trading because, again, research shows that over trading or constantly being in your trading account will result in a lower performance than just doing a buy and hold strategy. Okay. All right, so I'm going to go ahead and wrap up with this. Remember, when you're thinking about how you are going to sleep well at night, knowing that your portfolio is down, remember, if you make sound investments in the very beginning and you remember that it's slow and steady, that over time, even a small amount over a long period of time with a consistent return is going to yield profits, exponential profits over time. Remember, Rome wasn't built in one day, and neither will your stock portfolio be built in one day. With that being said, I want to thank you for your time and attention. Remember, we're teachers looking out for teachers. If you haven't already done so, please subscribe to the channel. And this is Dr. Diffins signing off. Bye-bye.